Okay, forgive me. I started on my personal channel by accident. I do not know what happened, or I started, something went wrong. So let me just check the audio and we'll get started. There we go. Okay. All right. Okay. I started on the wrong channel thinking that I was starting on this one, but here we go. I'd be grateful if you shared this around so some people can hear this. And last week we read up until page 153 in Stephen Hale's MMT book. Uh, what's it called? Economics for a Sustainable Prosperity. We read chapter 1, and now we're in chapter 5. And this is page 153. The section title is called Fiscal Sustainability. We're going to finish reading this chapter, and this is a good 30 pages, and then we'll continue on to chapter 7, but we're going to stop at the end of this 2 hours as far as this book is concerned. Then I'm going to go on next week to read Stephanie Kelton's 1998 paper regarding do federal taxes and bonds fund spending, federal spending. So it discusses exactly why taxes and bonds do not fund federal spending. It's a fascinating paper that I significantly understand. So that's next week. After that, I think I'm either going to get back to teaching lessons or I'm going to start reading Pavlina Cherneva's white paper from, I believe, April on the federal job guarantee. So here we go, page 153 in Stephen Hale's book, Economics for Sustainable Prosperity, page 153 in chapter 5. The section is titled Fiscal Sustainability. Next section, Fiscal Sustainability. Those economists who lack an understanding of monetary sovereignty waste a great deal of time and energy on an issue they describe as, quote, fiscal sustainability. To a modern monetary theorist, fiscal sustainability requires the government to run fiscal deficits high enough to allow the non-government sector, the private sector, and the rest of the world to fulfill their net savings desires while total spending remains at non-inflationary full employment. At the non-inflationary full employment level. It is sustainable because it does not require the private sector to go into debt and to increase the fragility of the financial system to maintain full employment. It is consistent with strong private balance sheets and strong financial regulation. It is fiscal surplus which are unsustainable in economics without trade surpluses, as they drive the private sector into debt, as was the case in Australia between 1996 and 2006. This is not what orthodox economists are referring to when they discuss fiscal sustainability, however. The orthodox approach to fiscal sustainability ignores the distinction between a currency issuer and a currency user, and so ignores the issue of monetary sovereignty entirely, and treats the governments of modern-day Greece and Australia, for example, as though they operate under similar monetary systems. Greece, as everyone ought to be aware, is not a monetary sovereign nation as it is in the Eurozone. Australia has a monetary sovereign government. Ignoring the distinction between them invalidates anything else you say about fiscal policy. The distinction is vital. It is why Greece, remaining within the euro, was not in a position to avoid a prolonged economic depression following the shocks of 2008 to 2010. Its government, as a non-monetary sovereign, unsupported by a central bank, was at the mercy, firstly of the bond market and secondly of the European Central Bank, the International Monetary Fund, and its fellow members of the Eurozone. Unemployment peaked at 27.5% in 2013, having been well below 10% during the 1980s and almost the whole of the 1990s. It remains above 20% in early 2018. The orthodox approach is rooted in a misunderstanding of the nature of money as stated in chapters 1 and 2, and is consequently also, even now, infected by the money multiplier fallacy, as we shall see. When, when misleading people about fiscal policy, as they so often do, orthodox economists start by writing down what they wrongly call a government budget constraint. It is not a constraint at all, since we know a monetary sovereign government faces no purely financial constraint. It is an identity, and one which can equally well be used to illuminate the interaction between fiscal and monetary policy from a modern monetary theory perspective, as to refer misleadingly to the constraints and policy sustainability from an orthodox one. So here's a formula. I'm just going to show it to you if you can possibly see that, and it's mirror image, but oh well. So G1 plus R1 B1 minus T, no, minus T minus 1. There you go. Oops. Plus delta B1 plus delta H. So G1 plus RT BT minus 1 plus TT, it's just too hard to see. I'll show you one more time. G1 is government spending in year T. BT minus 1 is the value of government bonds, or more correctly, debt securities, existing at end of year T minus 1. R1 is this doesn't really make sense to read this section. Just talked about a formula that is difficult to see. I'm going to skip. Okay, hopefully this is a better place to start. I'm skipping over everything that discusses the formula. Statements like the following one, which was written by a leading, this is continuing on page 158, and this is, just a moment. This chapter is called Modern Monetary Theory, so this is the basics of modern monetary theory. Okay, statements like the following one, which was written by a leading macroeconomist and founder of New Keynesian economics, who went on to become the vice chairman of the Federal Reserve, look absurd when you understand how monetary systems work. I cannot do otherwise than have an amazed reaction to Stanley Fischer having written this in 1990, and to wonder whether he believes it still. It is plain wrong for the most basic and fundamental of reasons. Quote, at some point it will be impossible for the government to sell its debt, and the process will have to be brought to an end by cutting the budget deficit. The point at which the process has to end depends on the expectations of the public. When the public recognizes the unsustainability of the government's fiscal policy, it will cease buying government debt and thereby force a change in policy. Close quote. Note, don't need the note. A monetary sovereign government does not need the public to buy its debt at all. Nobody can force a change in fiscal policy on such a government by threatening not to buy its debt securities, even if the government chooses to pretend otherwise. It does not have a compelling need to sell such securities in the first place. It does not need to get its currency from us. It cooperates with its central bank in the issuance of the currency. It cannot run out of its own currency unless it chooses to do so. The central bank can set the interest rate or yield on long-term government securities should it choose to do so. The decreasing yield to maturity on long-term Japanese government debt down the years, as gross government debt has gone from below 70% of GDP to a world record level of 250% of GDP. makes the point conclusively. The government with the most debt in the world relative to the size of its economy has an interest rate on its debt of approximately 0%. All this is obvious if you understand that official interest rates can be held permanently at zero, with fiscal policy used to manage total spending and financial regulation used to limit and influence the direction of private credit creation. It remains true that the government does not need to issue debt, however, even if you wish to maintain positive default, risk-free interest rates across the term structure. It simply requires the replacement of government debt securities with term deposits at the central bank. There are, of course, functionally identical liabilities for the consolidated government sector, but would be less likely to be seen as, quote, government debt, and more likely to be described as a form of broad, quote, money. This simple reform would do much to correct the misleading discourse generated by orthodox macroeconomists and commentators about government debt and so-called fiscal sustainability. Orthodox economists can be divided up into fiscal doves. I have already talked of a dovish approach to sound finance, and fiscal hawks, just as they could be divided into various forms of neoclassical synthesis, Keynesians, and various types of monetarists. Fiscal hawks believe governments should never run fiscal deficits except perhaps in wartime and recommend balanced budget legislation or some similar limitations on the government's fiscal space. They often cling to borrow Ricardian equivalents, which we have already rejected as absurd. Their approach to fiscal policy is unwise, liable to be pro-cyclical, and eventually to have catastrophic consequences. Fiscal doves, on the other hand, believe government should run deficits during and after economic downturns, but balance them out with surpluses during periods of strong growth. They fiscal balance should be zero on average across the economic cycle, or at least that they should only borrow for investment purposes like a business, and not for what is classified as government consumption. Their views are in conflict both with historical experience, as we have seen, and with mathematics I have just gone through. What they say sounds plausible, but it makes no sense. They may do less damage than fiscal hawks, but they still have the wrong frame for thinking about fiscal policy. Stephanie Kelton has chosen another bird for modern monetary theorists, labeling them as fiscal owls. Owls are, of course, famously associated with wisdom. Moreover, they can find their way in the dark, and there has been a lot of darkness as opposed to light being thrown on the appropriate role for fiscal policy by orthodox economists of both the hawk and the dove varieties. A deficit owl knows that the appropriate role for fiscal policy is not ever to balance the budget, but to balance the economy. There should be no target for the fiscal balance other than for it to be at the correct level to allow for genuinely sustainable, equitable, full employment. Sustainability here means taking into account real constraints and associated inflation risks and ecological constraints, and in that sense, the interests of future generations. The fiscal balance taken out of context cannot be it cannot be interpreted as good or bad. There will be occasions when the deficit should be 3% of GDP and occasions when it ought to be 10% of GDP. There will be occasions when it is appropriate to run a fiscal surplus. The fiscal balance should be what it needs to be to allow for non-inflationary full employment and sustainable prosperity. Both appropriate theory and historical data tell us that fiscal deficits are normal and usually necessary. It is understandable that so many orthodox and even some heterodox economists get the concept of fiscal sustainability so badly wrong. Their logic is based on the metaphor of the government as a household, and of course, it echoes the inescapable budgetary truths, which apply to all decision-making units other than the monetary sovereign governments. Every other economic unit faces a potentially binding intertemporal financial budget constraint, ignoring for the moment the option of bankruptcy. Every other economic unit must earn income, benefit from capital gains, run down assets, or run up debts or financial liabilities in order to finance spending, where debts must be repaid in the future. Every other actor in the economy faces insolvency risk. Only currency issuers, monetary sovereigns, are immune to that risk. Our normal, instinctive, System 1 approach is to imagine parallels between non-sovereign and sovereign budgets in terms such as budget deficit, which implies a shortfall or deficiency, and government debt, which implies something burdensome and in a sense immoral, which must be paid back. Bias us to draw these inappropriate connections, and these terms bias us to draw these inappropriate connections. It is unsurprising that politicians, journalists, and even economists habitually interpret the term surplus as something good, which is a sign of success akin to a company being in profit, and a deficit as something bad, as a sign of failure, like a corporate loss which could lead to insolvency. However, such parallels are not valid, as we have seen. Current arrangements are a veil, hiding the truth regarding the fiscal space available to monetary sovereign governments, and mislead not only the community at large, but also, as suggested above, the majority of economists. This is vitally important, and contributing in a small way to changing this misperception was a large part of my motivation for writing this book in the first place. End of this section, which we are on page 161. So when we get more people here and there is discussion, I'm going to stop every now and then to discuss. Um, Aaron, this is very prescient. Wait, darn it. Can I see the rest of the comments live? Okay. This is very prescient to Green New Deal being proposed in the U.S. I wonder if it would be possible to do reading like this at the community meeting for Green New Deal or Medicare for All. How do we break through the mainstream? I'm discouraged to see the Fix the Debt think tank was involved in new Congress orientation. Oh, really? I didn't know that. Is that part of what, I guess it's part of what Alexandria Ocasio-Cortez was saying? Um, but yesterday, Jeff and I, as Aaron, you know, Jeff and I, Jeff gave a presentation on the beginning of MMT to his neighbors, which I live streamed yesterday on this channel. And that seems to be the way that we're going to be able to start to reach people, and hopefully that will expand. Hopefully people will get excited about it and then help us reach more, but we'll see. So, all right, this is 18 minutes, so it's 32. All right, I'm continuing on. So this is page 161, chapter 5. The section name, this is Economics for Sustainable Prosperity by Stephen Hale. The section, next section. Money, banking, reserves, and the money multiplier fallacy. To replace orthodox economics with an economics for sustainable prosperity, we need the right frame for thinking about fiscal policy. That frame must be based on a correct understanding of the operations of a modern monetary system. To achieve this, we need to get the origins of money and the nature of money right, and we need a correct understanding of how banking systems work. Orthodox economists still get a lot of this wrong, and some well-meaning monetary reformers also get crucial elements of it wrong. You have to get it right, or you will mislead yourself and others. I have already said that the origins of money do not lie in a pre-monetary barter system of exchange, and the emergence from it of a form of commodity money. Instead, they lie at least partly in the emergence of early governmental institutions and a need for such institutions to provision themselves and consequently in taxation. Money as a unit of account was whatever was used to measure tax and other liabilities to the government, even if taxes could actually be paid in a variety of ways. The first such government determined units of value may have been weights of barley or other commodities. The important thing is that those units were chosen by governments. Government-created money tokens, which could be used by those who owned them, could make tax and other payments to those same governments, were probably issued very early on and have existed across the whole of monetary history. Even coins containing gold or silver were really just government tokens when they traded at a value above the market value of the metals of which they were made. Fiat money is nothing new. Fiat money, in the form of what can be regarded as IOUs issued by governments, which are really just tax credits, has existed for millennia. Money is a social institution, apparently invented by early governments. This is Knapp's state theory of money, KNAPP. It is the money of modern states over at least 4,000 years identified by Keynes. It is Charles Goodhart's theory C for Chartle, theory of money. It fits perfectly with the credit theory of money as shown by Mitchell-Innes and later by Minsky. More importantly, it fits well with anthropological and archaeological evidence according to a wide variety of sources. Modern money is that which is necessary to pay your taxes, as well as the unit of account in which your taxes are calculated. In the USA, modern money is the US dollar. In Australia, it is the Australian dollar. In Japan, it is the yen. In early monetary societies, it was whatever unit the central authority determined it to be. As Keynes said, modern states write the dictionary where money is concerned and set the rules. The government and its central bank are in charge of a monetary system which is based on financial assets and financial liabilities, or on credits and debits. As Minsky said, the fact that taxes need to be paid gives value to the money and to the money of the economy. As Mitchell-Innes said, money then is credit and nothing but credit. A's money is B's debt to him. I do. A's money is B's debt to him, and when B pays his debt, A's money disappears. This is the whole theory of money. And that's all a quote by Minsky. To make sense of all this, we have to distinguish between vertical or outside government money and horizontal or inside or private credit money, and to understand the relationship between them. This involves making a distinction between the monetary base and other official measures of the monetary supply, and another one between money and quasi-money. It requires us to understand that there is a hierarchy of money in a modern monetary system. The monetary base, which orthodox economists often wrongly label high-powered money, hence the label H earlier in the chapter, which I will retain here, consists of currency in circulation, C, plus private banks reserves, R, held partly in the form of vault money, cash, and partly as sight deposits of federal funds, known as exchange settlement funds in some countries at the central bank. So H is high-powered money, C is currency in circulation, and R are bank reserves. So H equals C plus R. The base money, H, must be either spent into existence by the monetary sovereign government or lent into existence by the central bank. In an accounting sense, it consists of financial liabilities of the central bank. Since the central bank could be consolidated and should be consolidated into the government, we can describe base money as consisting of some form of the financial liabilities of the government. In that sense, it is a form of credit, but it is a form of credit which has been issued by a monetary sovereign government and so can only be repaid with other IOUs of that government, or used to pay taxes or make other payments to that government. It is government money. It is vertical money in the sense that it is passed down from the government sitting at the apex of the financial system to the private sector. It is outside money since it is coming from outside the private sector. When it is spent into existence by the government, rather than lent into existence by the central bank, it is an addition of net financial assets to the private sector. Government money is a financial asset for the private sector. It is not a financial liability for the private sector. Its issuance as a result of government spending does not require anyone in the private sector to carry a debt. It is common to read that 97% or some such proportion of the money supply in a country has been created from nothing by private banks, and that the private banks create money without limit and outside of the control or even the influence of the government and its central bank. Such statements are at best partly true, in some respects completely wrong, and have the capacity to be profoundly misleading. Official measures of the money supply, MS, include currency in circulation, C, and deposits held at its private banks, D. So the money supply is MS, currency in circulation is C, and deposits held at private bank is D. Currency in circulation is of course a financial liability of the government, as I have just said. Deposits held by households and non-bank businesses with banks are financial assets of those households and non-banking businesses and some other institutions, and financial liabilities of the banks. Both households or businesses and banks are part of the private sector, so that these deposits are not net financial assets for the sector as a whole. Or they're part of the private sector so that these deposits are not net financial assets for the sector as a whole. They are horizontal money or inside money, since they are created within the private sector rather than being passed down to the private sector by the government. So MS, money supply. Where are we? Where'd it go? MS, money supply, equals currency in circulation plus bank deposits. Thank you, Aaron. It is just being you at the moment, but hopefully more people will read it later. Bank deposits are mainly the result of banks creating credit for their customers. Monetary reformers who claim that banks create money, quote, out of thin air, are entirely right in this respect. Given that all money is some form of credit, and that credit, or debt, depending on which term you prefer to use, is always a contractual relationship created out of nothing, it must be true. All money is credit and nothing but credit, as Mitchell Innes said many years ago, but we need to dig a little deeper. The following is a very, very highly simplified balance sheet of a private bank, Table 5.1. Let's see. Okay. So Table 5.1. Assets is what the bank owes. Can you see that? So cash reserves, what does that say? Including federal funds, credit to customers and other assets. That's assets, what the bank owes. Mirror image. Oh well. Liabilities, what the bank, assets are what the bank owns, and liabilities are what the bank owes plus equity. And that's deposit liabilities and other deposit and other liabilities and equity reserves. So just look at that for a minute in mirror image. Okay. You can immediately see that a potential source of confusion which often catches people out. This is the use of the word reserves to stand for two very different entries on the balance sheet. On the one hand, people talk about the reserves of federal funds and vault money, and on the other hand, of reserves or capital or equity. Looking at the balance sheet, these are obviously different things. We will concentrate first on cash reserves. These reserves are assets. In other words, something the bank owns. Test 1, 2, 3. Test 1, 2, 3.
Disconnected.
Test 1, 2, 3. There you go. Something was wrong with my Bluetooth. Can't believe it. 1, 2, 3. There you go. Something was wrong with my Bluetooth. Can't believe it. 1, 2, 3. There you go. Something was wrong with my Bluetooth. All right. So, Aaron, please tell me where you remember hearing last. I mean, what the hell am I supposed to do here? Can't believe it. No, it froze because I turned it off and turned it back on to test that, and now it should be back. Something was wrong with my Bluetooth. I don't understand. Maybe if I connect it again, I'm going to try and connect it again. Hopefully that will work. Yes, you can hear me. Wonderful.
Connect.
Test 1, 2, 3. Trying the Bluetooth again, seeing if that works. Okay, test 1, 2, 3 again. It works. Can't conceive of what happened. All right. Whatever. Aaron, if you could tell me where it stopped, I could go back to that spot. I mean, what else? The whole point of this. All right, well, thanks. At least I only wasted 20 minutes and not, I don't know. Well, the point of this is to read the book, and that I don't know where it stopped. Actually, I guess I could figure out where it stopped. If you give me a moment, I can go back. Let me see where it stopped. Can't believe it. 22 minutes. 25 minutes. 25 minutes. Um, all right, just give me a moment. I'm going to see if I can actually figure this out where I actually left off. There it goes. There it died. Okay, so hold on. Okay, I figured out where. Hold on. These reserves are assets. Yes. Okay. Wow. That is a lot of pages. All right, here we go. 7 people. Welcome. Where are all you guys from? Okay, whatever. I guess at least one person heard no sound as opposed to 7 people, but here we go. I'm going to start the section over again, and it is a beast of a section. It is really, really long, but none of it was heard, so let's do it. All right, so I'm on page. First of all, I'm in Stephen Hale's MMT book called Economics for Sustainable Prosperity. I'm reading chapter 5, which is about modern monetary theory. And this section is on page 161. It's a very long section, but almost all of it was cut out. Yeah, thanks, Dan and Aaron. I just wasn't paying attention. The comments pop off after like a minute or whatever, and I didn't notice. I guess I don't know, be more careful. I don't know. So page 161, chapter 5, the section is called Money, Banking, Reserves, and the Money Multiplier Fallacy. So this is a section. And I might as well say, I just read Stephanie Kelton's paper from 1998, and I think it was republished in 2000 or 2001, about do taxes and bonds fund federal spending? And it is a fascinating paper and is completely what do not expect what it's about. And what it's about is banking reserves. So banks are required to carry 10%, according to what I just read at the beginning of this year, 10% of reserves, 10% of their money in reserve at, I guess, the um, regional reserve banks in order to prevent potential crises. But the problem is that people withdraw their money, they spend their money, they pay taxes. We all pay taxes in April, but there's quarterly taxes with businesses and so on. So it is impossible to calculate that 10% accurately in the moment. So there's delays that you have to have 10% of what the average has been over the past week, and it's very complicated. But it boils down to reserves. And the Treasury, the federal government, injects money into the Federal Reserves on a daily basis based on the taxes, based on, in order to keep that interest rate on those reserves stable, I believe. So there's 10% and you get interest on that reserve, on those 10% reserves. They collect interest on those reserves. They make profit on those reserves. So 10% in sitting in the treasury or in the regional reserves collects interest. But they do not collect interest if it's above 10%. And if it's below 10%, they're violating the law. So it's a very tricky balance because the money going out and going in from our point of views, when we go get money, it's very hard for the bank to keep up with exactly what that 10% is. And they also don't want to keep excess reserves in because they don't earn interest when it's above 10% or whatever the amount is. So it's a very tricky operation. And taxes and borrowing are the way, or a tool for the federal government to to balance that amount. I'm starting to lose it knowledge-wise. But taxes and borrowing don't fund federal spending, but they are a tool to help balance that reserve amount so that the interest rate on those 10% can remain stable, and so the banks can have the proper amount of money in the bank to have that 10% as they're required to do. So this section goes into that. And next week I am planning on reading Stephanie Kelton's paper in full, um, and it's fascinating. It is mind blowing that our taxes don't pay for federal spending because of bank reserves. That's just really mind twisting, but that's what it's about. So here we go. Section, page 161, chapter 5, money, banking, reserves, and the money multiplier fallacy. I guess I just have to keep a watch on that Bluetooth blue. To replace orthodox economics with an economics for sustainable prosperity, we need the right frame for thinking about fiscal policy. That frame sorry. That frame must be based on a correct understanding. I'll just start over. To replace orthodox economics with an economics for sustainable prosperity, we need the right frame for thinking about fiscal policy. That frame must be based on a correct understanding of the operations of a modern monetary system. To achieve this, we need to get the origins of money and the nature of money right, and we need a correct understanding of how banking systems work. Orthodox economists still get a lot of this wrong, and some well-meaning monetary reformers also get crucial elements of it wrong. You have to get it right, or you will mislead yourself and others. I have already said that the origins of money do not lie in a pre-monetary barter system of exchange, and the emergence from it of a form of commodity money. Instead, they lie at least partly in the emergence of early governmental institutions, in a need for such institutions to provision themselves, and consequently in taxation. Money as a unit of account was whatever was used to measure tax and other liabilities to the government, even if taxes could actually be paid in a variety of ways. The first such government-determined units of value may have been weights of barley or other commodities. The important thing is that those units were chosen by governments. Government created money tokens which could be used by those who owned them to make tax and other payments to those same governments, were probably issued very early on and have existed across the whole of monetary history. Even coins containing gold or silver were really just government tokens when they were traded at a value above the market value of the metals of which they were made. Fiat money is nothing new. Fiat money, in the form of what could be regarded as IOUs issued by governments, which are really just tax credits, has existed for millennia. Money is a social institution, apparently invented by early governments. This is Knapp's state of theory money, KNAPP. It is the money of modern states over at least 4,000 years, identified by Keynes. It is Charles Goodhart's theory C, C for Chartle, theory of money. It fits perfectly with the credit theory of money as shown by Mitchell-Innes and later by Minsky. More importantly, it fits well with anthropological and archaeological evidence according to a wide variety of sources. Modern money is that which is necessary to pay your taxes, as well as the unit of account in which your taxes are calculated. In the USA, modern money is the US dollar. In Australia, it is the Australian dollar. In Japan, it is the yen. In early monetary societies, it was whatever unit the central authority determined it to be. As Keynes said, modern states write the dictionary where money is concerned and set the rules. The government and its central bank are in charge of a monetary system which is based on financial assets and financial liabilities, or on credits and debts. As Minsky said, the fact that taxes need to be paid gives value to the money of the economy. Close quote. As Mitchell-Innes said, quote, money then is credit and nothing but credit. A's money is B's debt to him, and when B pays his debt, A's money disappears. This is the whole theory of money. Close quote. To make sense of all this, we have to distinguish between vertical or outside of or outside of government money and a horizontal or inside or private credit money, and to understand the relationship between them. This involves making a distinction between the monetary base and other official measures of the money supply, and another one between money and quasi-money. It requires us to understand that there is a hierarchy of money in a modern monetary system. The monetary base which orthodox economists often wrongly label high-powered money, hence the label H earlier in the chapter, which I will retain here, consists of currency in circulation, C, plus private bank reserves, R, held partly in the form of vault money, cash, and partly as sight deposits of federal funds, known as exchange settlement funds in some countries, at the central bank. So H equals C plus R. Unless I can zoom in. H equals C plus R. The base money, H, must be spent into existence by the monetary sovereign government, or lent into existence by the central bank. In an accounting sense, it consists of financial liabilities of the central bank. Since the central bank should be consolidated into the government, we can describe base money as consisting of some form of the financial liabilities of the government. In that sense, it is a form of credit, but it is a form of credit which has been issued by a monetary sovereign government, and so can only be repaid with other IOUs of that government, or used to pay taxes or make other payments to that government. It is government money. It is vertical money in the sense that it is passed down from the government sitting at the apex of the financial system to the private sector. It is outside money since it is coming from outside the private sector. When it is spent into existence by the government rather than lent into existence by the central bank, it is an addition of net financial assets to the private sector. Government money is a financial asset for government money is a financial asset for the private sector. It is not a financial liability for the private sector. Its issuance as a result of government spending does not require anyone in the private sector to carry a debt. It is common to read that 97% or some such proportion of the money supply in a country has been created from nothing by private banks, and that private banks create money without limit and outside of the control, or and banks create money without limit and outside of the control or even influence of the government and its central bank. Such statements are at best partly true, in some respects completely wrong, and have the capacity to be profoundly misleading. Official measures of the money supply, MS, include currency in circulation, C, and deposits held at private banks, D. Currency in circulation is of course a financial liability of the government, as I have just said. Deposits held by households and non-bank businesses with banks are financial assets of those households and non-banking businesses and some other institutions, and financial liabilities of the banks. Both households or businesses and banks are part of the private sector, so that those deposits are not net financial assets for the sector as a whole. They are horizontal money or inside money, since they are created from within the private sector, rather than being passed down to the private sector by the government. So this is the formula. MS equals C minus D. What is that? MS? Money supply. Money supply equals currency in circulation plus bank deposits. Bank deposits are mainly the result of banks creating credit for their customers. Monetary reformers who claim that banks create money out of thin air are entirely right in this respect. Given that all money is some form of credit, and that credit or debt, depending on which term you prefer to use, is always a contractual relationship created out of nothing, it must be true. What? Given that money is some form of credit, it must be true. Okay. All money is credit and nothing but credit, as Mitchell Innes said many years ago, but we need to dig a little bit deeper. We need to dig a little deeper. The following is a very, very highly simplified balance sheet of a private bank, table 5.1. So here we go. That's it. Unfortunately, this is mirror image, but oh well. So I'll zoom in. That's the right side, the assets of a bank, and that's the left side, the liabilities of a bank. You can immediately see a potential source of confusion, which often catches people out. Oh, I wonder, can I do that? No, there's no way. I was wondering if there's a way to take a picture and put it up on screen. Oh well. Yeah, if you need to see that again or something, tell me. You can immediately see a potential source of confusion which often catches people out. That is the use of the word, quote, reserves to stand for two very different entries on the balance sheet. On the one hand, people talk about reserves of federal funds and vault money, and on the other hand, of reserves of capital or equity. Looking at the balance sheet, these are obviously different things. We will concentrate first on cash reserves. These reserves are assets. In other words, something that the bank owns. Ignoring vault money, they are those federal funds held on deposit with the central bank, which are available to facilitate interbank transactions, ensuring that the bank can meet its obligations relating to day-to-day money transmission within the financial system, to facilitate private sector, public sector transactions, and to allow for other transactions between the private bank and the central bank. Textbooks down the ages have commonly assumed a requirement for banks to hold a fixed minimum ratio of cash reserves to deposit liabilities, and often, to make the sums easy, have set this ratio to 10%, which happens to be the current requirement of the U.S. Federal Reserve. Show that table one more time. In practice, many countries do not have such a requirement or set it at zero, although others, including, as I have just said, the USA, still maintain such minimum reserve requirements for private banks. When the central bank pays no interest or below market rate of or a below market rate of interest on federal funds, such a requirement can be seen as a tax on the banking system. In countries like the USA, where reserve requirements are calculated as averages over a period of time, rather than on a continuous basis, there are technical reasons which I will not explain here why having such a requirement simplifies the task of the central bank in managing the supply of liquidity to the banking system. What such requirements certainly do not do and have not done for at least for many decades in countries like the USA is to limit the ability of private banks to create credit, and by doing so to create horizontal money and to add to the money supply. Note 14, this is explained with great clarity in Fullwiler 2017. Banks definitely do not need additional reserves or excess reserves to facilitate additional lending. Central banks like the Bank of England and the Federal Reserve have made this clear on numerous occasions in a variety of publications, but it is something many bankers know from experience. As Alan Holmes, the then vice president of the New York Federal Reserve, said in 1969, before the breakdown of the Bretton Woods system, quote, "In the real world, banks extend credit, creating deposits in the process, and look for reserves later." Um, when a bank provides a customer with credit, this requires two balance sheet operations, neither of which involves reserves. If the bank lends its customer $1,000, then what the bank is actually doing is exchanging financial claims with its client. The bank now owns the loan agreement signed by the customer. This is a financial asset for the bank and a financial liability for the customer. It is a financial claim the bank has on the customer. At the same time, the bank has created an additional deposit on which the customer can now draw. This is a financial asset for the customer and a financial liability for the bank. It is a financial claim the customer has on the bank. Credit to customers has increased by $1,000 on the asset side of the balance sheet. Deposit liabilities has risen by $1,000 on the other side. Until the funds are spent, there are no implications for reserves. Even then, if they are simply transferred between customers of the same bank, as often happens in highly concentrated banking systems, there are no implications for federal funds. It is possible that this deposit creation might require the bank to supplement its reserves, either as a result of reserves being depleted by a subsequent transfer of funds between accounts held at different banks, or to meet minimum reserve requirements now that deposit liabilities have been increased. In the USA, reserve requirements have to be met on average over a 2-week period, 17 days after the end of the 2-week period during which the minimum level of required reserves is calculated. It is very clear that in the USA, banks create credit now and then. It is very clear that in the USA, banks create credit now and then, go about acquiring the necessary reserves later. I think that's a typo. And then create now. Oh. It is very clear that in the USA, banks create credit now and then go about requiring the necessary reserves later. It is not the other way around. Even if it was the other way around, and if banks did need the reserves before they were permitted to create additional credit, if reserves were freely available, a shortage of reserves would never prevent a bank from providing credit to the customers it deemed to be creditworthy, who were prepared to pay market interest rates. And remember, in countries like Canada and Australia, There are no such minimum cash reserve requirements at all. Additional reserves of federal funds or exchange settlement balances are always available, in practice, for very good reasons. Central banks must ensure that this is the case or they would lose control of overnight interest rates on the money market, which would invite financial instability and a potential crisis. The overriding responsibility of the central banks is to maintain the stability of the banking and monetary system. Consequently, central banks buy and sell government and other securities and engage in lending and borrowing on the money market every day to ensure that sufficient liquidity is available to the banking system to prevent money market interest rates from spiking. Banks looking for reserves will normally borrow them overnight or short term from banks with excess reserves. It is the job of the central bank to ensure that it supplies sufficient reserves to the system to allow for this to take place. In other words, central banks must ensure a sufficient monetary base to meet the aggregate needs of the banking system and to avoid volatility on the money market. This is according to Fallweiler, 2017. The sequence of events is that banks create credit by lending to customers. This can over time lead to an additional demand for reserves in the banking system. The central bank can and does meet this demand for reserves by creating them, often simply by purchasing government securities from the private sector and paying for them by crediting bank federal funds reserve accounts. This allows the central bank to maintain the federal funds rate at its target level. The banking system does not require these reserves in order to lend. The central bank is forced to supply the reserves after the event. To do otherwise, as was experimented with briefly in the USA at the beginning of the 1980s, and even more briefly in China in the middle of 2013, is to invite volatile interest rates and a dysfunctional banking system. Orthodox textbooks often rewrite expressions for H, high-powered money, and MS, or money supply, defining C as the ratio of currency at issue to total deposits. I'm skipping this. This is just a big formula. I'll show it to you, but it doesn't make sense to discuss a big formula. Okay. If we assume R equals 0.1, a 10% minimum cash reserve ratio, and C equals 0.03, let's accept the statement that only 3% of the money supply is fiat money, then the resulting money multiplier would have a value of almost 8. But it isn't really a multiplier at all. It would only be a genuine multiplier if banks needed additional reserves before they could increase lending. And we're always faced with a queue of unsatisfied but credit-worthy potential borrowers to lend to, so that the creation of additional reserves automatically caused additional credit creation. If that If that was true, central banks could control credit creation and the money supply by limiting the supply of reserves and base money, or increasing the requirement reserved ratio, required, or increasing the required. History tells us that this is not the case, and that attempts to do just this have ended in failure. An understanding of how our monetary institutions work tells us that things could not possibly work this way. In practice, during periods when there has been any correlation between the growth in the monetary base and the money supply, it has been because of a money divisor and not a money multiplier. Increases in the money supply due to additional lending have eventually increased the demand for reserves in the banking system, which the central bank has then had no alternative but to supply. Consequently, The monetary base has increased endogenously in response to endogenous money creation. Central banks do not control any measure of the money supply, and outside of periods when they create excess reserves through quantitative easing, they do not control the amount of base money in the system either. Both are determined endogenously. There is no money multiplier. Central banks instead manage short-term interest rates and, as recent experience has shown, have the power to control long-term rates too. And I'm defining endogenous. Have is an adjective having an internal cause or origin. The expected rate of infection is endogenous to the system, confined within a group or society. How many pages is left in this section? 4 or 5. So I'm on page 168. During and after periods of large-scale reserve creation due to quantitative easing, as in the USA, Europe, Japan, and the UK since 2008, there can obviously be no shortage of reserves in the banking system, and the notion of a money multiplier effect becomes an absurdity. This did not stop some economists, policymakers, and commentators forecasting hyperinflation when quantitative easing was first implemented. More recently, it has not prevented them from arguing that the money multiplier has only failed temporarily because interest rates are at, quote, the lower bound, or because banks don't want to lend. They have continued to worry about banks, quote, using excess reserves to facilitate a credit binge when the economy has picked up. All this is nonsensical and based on a misunderstanding of the microeconomics of banking. Banks do not need reserves to lend in the first place, as I have explained. Consequently, supplying excess reserves to banks as a result of large-scale purchases of government securities and other assets from the private sector does nothing to encourage or force banks to create additional credit. All quantitative easing can do and has done is to have an impact on the prices and yields on those assets that the central banks have purchased, notably long-term government securities, and consequently, broader effects on financial markets. Other than that, quantitative easing, or QE, has not been inflationary, which should surprise no one who knows it mainly involving swapping one interest-bearing government liability, reserves, for another very similar one, government bonds. Insofar as the interest rate on reserves is below the interest rate paid on government securities, quantitative easing can even be deflationary since it reduces future interest payments from the consolidated government sector to the private sector. The creation of excess reserves has also changed the approach those central banks which have engaged in quantitative easing have used to control official interest rates, as we shall see. Before doing so, however, let us return to our simplified bank balance sheet and discuss the nature and purpose of the other form of reserves, which are to be found in the bottom right-hand corner, equity reserves. All right, I'm going to show you that table one more time. Let's see. Here we go. Okay, table one more time that we're about to talk about again. I'm assuming it's a little blurry, but it's the best we got. I'll show the right side zoomed in. Oops, I'll show the right side zoomed in. And the left side. Sorry for the mirror image. I don't know what I can do about that. Okay. Okay. Let us return to our simplified bank balance sheet and discuss the nature and purpose of the other form of reserves which are to be found in the bottom right-hand corner, equity reserves. Equity reserves are not assets of the bank. They are not something the bank owns. Instead, they are calculated as a residual by deducting the bank's deposit and other liabilities, corporate bonds and money markets, and money market debt securities issued, etc., from the value of the bank's assets. They are the value of the net assets or net worth or equity capital or equity reserves of the bank. In practice, the definition of a bank's capital base is complicated, and to discuss it would involve distinguishing between Tier 1 and Tier 2 capital and delving into a variety of hybrid securities and accounting jargon. Let us keep it simple. Our definition is similar to what bankers call common equity Tier 1 capital. It is shareholders' stake in the bank. It can be increased by selling additional shares to the bank shareholders, but the normal reason for a bank's equity to rise over time, at least during good times, is the accumulation of retained profits. When a bank makes an after-tax profit and does not pay it out in dividends to its shareholders, the net asset value of the bank will increase, which means its equity reserves will rise. While a bank does not need cash reserves to lend it to its customers, it does need equity reserves either to make additional loans or to take other banking risks. Since the 1980s, there have been international regulations relating to bank capital adequacy, which started off relatively simple but have become very complicated. They are often called the Basel Rules, BASEL, as they were negotiated and have twice been renegotiated by central bankers at the Bank for International Settlements in Basel in Switzerland. We will avoid discussing things like operational risk, risk-adjusted assets, and the use of banks' international risk models, and grossly oversimplify again to focus on the issue of interest to us. That issue is the fundamental purpose of these equity reserves. Equity reserves are there as a shock absorber, supposedly ensuring that the bank remains solvent and in a position to repay its depositors and other creditors without government assistance, even after the bank has made losses due to the non-repayment of loans by its customers, or for reasons relating to other banking risks. What the capital adequacy regulations do is to require banks to increase their equity capital to a minimum level before they are permitted to take on additional risks, including the risks associated with additional commercial lending. So it is true that banks create horizontal money from out of thin air. It is true that this credit money can add to the fragility of the financial system as it creates a debt which the customers of the bank will be required to repay in the future. It is not true that the government needs to or even could borrow this money from the banks. Indeed, the only way banks can purchase government securities when they are issued is by using their reserves of federal funds, which are of course base money or vertical money, or as we might say, government money. It is true that banks don't require cash reserves or balances at the central bank before they create credit. It is not true that banks face no limitations on their ability to lend. Before they can lend, they need to find credit-worthy customers who want to borrow and who are prepared to pay high enough interest rates to allow the bank to make a profit. They also need to meet the rules laid down by the banking regulator, which in many countries is the central bank itself. Most notably, they need to have sufficient equity capital to meet the Basel rules as interpreted and enforced by the local banking regulator. There have been many scandals involving major banks in recent years, and there are undoubtedly serious flaws in banking regulation. Most modern monetary theorists would like to see a banking system which serves the capital development of the economy rather than acting as a facilitator of and participant in speculative financial markets. This involves concentrating more on the assets side of a bank's balance sheet and less on its liabilities and equity. The core activities of commercial banks are, after all, running the money transmission system and the creation of credit. It would be a simple matter using our current technology to locate money transmission and transaction accounts in the central bank or at least in a public institution. This leaves the underwriting of a private debt and the creation of credit as the core economic functions of private commercial banks. If it seems reasonable to argue that private regulated institutions do a better job in identifying creditworthy borrowers and financing projects contributing towards sustainable prosperity than a government institution would do, then then a government institution would do, then there is a case for the existence of private banks. However, they are effectively operating as franchisees of the state. The government has extended them a franchise to create money in the form of their deposit liabilities, backed by the government's guarantee. Banking practices which do not involve money transmission or forms of lending consistent with the pursuit of sustainable prosperity should be restricted or forbidden. There are good reasons to consider breaking up the largest banks, to remove the moral hazard associated with too big to fail institutions and for reducing their political influence. There are good reasons to consider a return to banks concentrating on a narrow range of activities in a modern day version of the Glass-Steagall Act with its separation of commercial and investment banking. There may be good reasons to consider the partial or even wholesale nationalization of commercial banking outside of small mutual banks. There is much that needs to be changed or where a good there is much that needs to be changed or where a good case can be constructed for changes. But we do not need to eliminate the ability of deposit-taking institutions to create money by creating credit, and indeed we should not do so. We do not need 100% reserve banking. Most of all, we do not need a committee of quote experts deciding somehow on how much money should be created each year. Those who argue for this kind of reform do not, in my view, understand the importance of an elastic supply of credit in the capital development of the economy, or the fact that monetary sovereign governments are already free of financial constraints, are already in a position to regulate the banking system effectively, and could already ensure it operated in the best interests of sustainable prosperity, should they find it politic to do so. This in one more page, two more pages. Hyman Minsky famously said that anyone can create money, but the problem lies in getting it accepted. Um, Government money is accepted as having value because people need to get it in order to pay their taxes and make other payments to the government. The tax collecting power of the state lies behind fiat money. Its acceptance is not based on trust, but on the willingness of the state to use its tax collecting powers to defend the value of the currency. Bank deposits are accepted as having value because they can be used to repay debts to banks and to others at par because there is a guarantee that they can be converted into government money at par, and in the case of transaction accounts, on demand. Other private sector financial liabilities will have at least some of the characteristics of money if they are issued by a borrower with a very high credit rating, and if that borrower agrees to take them back on demand or to accept them in the repayment of debts to itself at par against government money. Alternatively, private sector financial liabilities might be seen as being almost as good as money or, quote, quasi money, even if they cannot be used directly in exchange for goods and services where they are easily transferable, like debt securities in a highly liquid secondary market, if their value on that secondary market is stable and if they have virtually no default risk. The distinction between, quote, near monies or quasi money and bank deposits can become blurred, so that the owners of these assets forget that they are further down the monetary hierarchy than insured bank deposits, and consequently more risky to hold, as was the case with units in money market funds in the USA prior to financial markets. As Keynes said, quote, "We can draw the line between money and debts at whatever point is most convenient for handling a particular problem." Note 17. This is written as an endnote in to page 167 of Keynes, which is a 1936 book or paper. Continuing. While monetary sovereign government securities, including bonds, are generally not included in official measurements of the money supply, they are default risk-free assets for the private sector to hold, and if they are held to maturity, they have a safe nominal value. What is more, they are not really debt. Yeah. They are not really debt in the conventional sense of a burden which must be paid back at all. Their prices on the secondary market vary over time in line with charges in default risk-free interest rates. Although we should not forget that central banks can control these rates and prices should they choose to do so. Government bonds are effectively a transferable term deposit at the central bank, and I would like to see them formally redefined as such. They could then be regarded as a form of broadly defined vertical money rather than being subject to the quote government as household debt metaphor. It is a mistake to obsess over the precise definitions of monetary aggregates, and all money is some form of debt in any case, as we have already established. But I still believe this reform would have a transformative effect on the discussion of the government's fiscal stance. During periods of euphoria on financial markets, private sector debt securities can become seen as almost identical to government securities as happened with mortgage-backed securities in the lead up to the global financial crisis. They came to be seen as quasi-money and were erroneously classified as such by the credit rating agencies. The distinction between vertical government money, including government securities, and uninsured private sector financial liabilities is one which ought never to be forgotten by banking supervisors, central bankers, and governments. There is no good reason for private asset-backed securities or credit derivatives them to exist at all, associated with them to exist at all. Oops. The practices which led to the financial crisis should never have been permitted. We did not need them. Whew. All right, end of section, page 172. The next section is called Monetary Policy in the Real World. Whew. Any comments? I don't think so. Oof, look at that. Let's see. Dan, Dia. Oh, I thought it was Dan. I'm sorry. Dia. Mosler explains how that works on one of his videos where he explains what happens when you buy a house. 39. Is that now? No, that was a while ago. Gosh, long chapter. I've been reading this for 25 minutes. Thank you. I'm interested in seeing that video because it's obviously pretty critical to understand how the reserve banking works. Yeah, so this is very technical and obscure to normal people, and I think that this is where Fed giving credit. Yes, thank you. That was when, so yeah, let me read that comment. So Dia says, Mosler explains how that works on one of his videos where he explains what happens when you buy a house. That was when you were talking about the Fed giving credit, right? Yeah, so the fact that taxes and borrowing do not fund federal spending, it's easy to say that. But the reason it doesn't is really difficult for a layperson to understand. It takes an incredible amount of explanation to get into reserve banking, and I don't understand it yet. I just get the very basic concept that preserving that proper reserve balance where they earn interest and greater they don't earn interest and lower they get in trouble. That's that preservation and that dance between the banks and the reserves and the government is the background, the reason of why federal taxes and borrowing do not fund federal spending. The details of that. Um, so I would stop for more discussion if there was. Oh, let's see. Yes, it does. You are doing great. Thank you. I'm not sure what yes, it does is referring to. I forgot. Oh, yeah, I got it. Yeah. So it does refer to the reserve banking refers to the details of that is the reasoning of why taxes and borrowing don't fund federal spending. And that is a really, really out there thing to explain to the general public. And I frankly don't totally understand it either. Dia says, yes, it does. That reasoning is correct. And I am doing well, thank you. It's nice to hear since feeling a little lonely, but doesn't change the fact that I know this is useful, and it's certainly at least useful for me. Yes, it is hard for lay people. Totally agree. It's hard for me, and I've been studying this stuff since February and reading Stephanie Kelton's paper, which I'm going to be reading on this show next week. Completely blows my mind, and I don't totally get it. I get, I would say, more than half of it. Um, so, actually, I mean, whatever. I'm going to be reading Stephanie Kelton's paper on next week's show. I may continue depending on how long it takes. It's 28 pages long or 24 pages long. I may continue, depending on how many people are here, to continue with Randy Ray and Stephanie Kelton's paper, 11-page paper on saving Social Security from its quote saviors, which is another interesting paper. Unfortunately, it's based on a big chart, which is impossible to get across in an audio form. I mean, I can show it, but it's only so much you can do. But still, the paper is interesting, so that might be next. And I might get back to teaching my lesson because I've learned quite a lot. And actually, I want to step aside. I want to learn in general. I want to deepen my knowledge more instead of going out and trying to debate people, not debate, but teach people, um, because I'm solid on the basics now, the very, basics, and I want to get deeper so I can get, handle more of these things, hyperinflation and reserve banking and whatever. So anyway, that's my goal. All right, so I'm going to go on to the next chapter. This is page 172, chapter 5 in Stephen Hale's book, Economics for Economics for Sustainable Prosperity. Oh, it's 5 o'clock. Oh, it's 5 o'clock. I didn't realize it was 5 o'clock. All right, I'm gonna stop. I'm gonna stop. I didn't realize I've been going on for 2 hours. Okay. Um, Dia, thank you for being here. Aaron, thank you for being here before. I am getting a lot out of this. I only got on this YouTube channel. I've had it for a while, but I've never really used it up until a month ago. So I have less than 100 followers. And until I get to 1,000, I can't even ask people to contribute. I mean, there's a link in the description to contribute, but Jimmy Dore and Graham Elwood and Ron Procone, they can ask for donations right here. Yeah, time flies when you're having fun. Yeah, 2 hours of reading. I gotta, my throat, it's crazy. So I cannot even ask for donations until I get to 1,000 viewers. But clearly, I mean, there's really no one here, so I'm not sure how that's going to happen. Reading a book is not going to attract a ton of people. I don't know. I don't know. But I'm learning. So anyway, and Dia's learning, and Aaron's learning. So uh, thanks for spending time, and I'm sorry for the 20 minutes of no audio. But I read the section again, and I learned it a little bit more. So thank you. So I read up to page 172. I read chapter 1 in the previous video, began chapter 5, and I continue chapter 5. I'm going to stop reading this book now on this show. I'm going to move on to other papers and so on. But enjoy the end of the weekend, and thank you for being here. Good night, Dia. You are welcome, and thanks for being here. Bye.